Obtaining a mortgage today is the exact same, but the cost is going to look very different. And that's what we're going to talk about today. My name is Mariah Taliaferro. I'm a realtor with Premier Sotheby's International Realty, specializing in downtown Sarasota and the surrounding Keys. And I'm joined with Jose Moreno with Synovus Bank, who is an expert in mortgages. Thank you so much, Jose, for joining us.
Hi, Mariah. How are you today?
Doing awesome. So, Jose, this topic is a little sensitive for a lot of people. Prior to today, earlier in the year, rates were very different, and it was pretty inexpensive to get a loan. And we saw that trickle down in the amount of properties that were sold and people getting investment properties, second homes, and things like that. We've talked about the shift in the marketplace, but let's talk about what the trickle down effect has been when it comes to mortgages.
Okay. Well, basically what's taking place at this moment is that the rates are different to what they used to be, but in reality, the rates were extremely low. They were very low for, I'd say, maybe the last 2 years. And people got used to those kind of rates. And now the rates are more normal. I mean, depending on what your definition of normal is, but it's just that they were extremely, extremely low.
Yeah.
And so people get used to a payment, they get used to a term. And so when reality sets on what the new terms are, then the payments do make an impact. So I just want to kind of give an example, just not to start throwing numbers around, but basically, back in January, a 30-year fixed mortgage rate was at 3.25%.
Okay. Yeah.
And just to give you an example, a mortgage on a purchase price for $625 with 20% down, which is a $500,000 loan, the payment was at 3.25%. It was $2,176.
Okay.
Today's rate is at 6 1/8. The payment is now for the same mortgage is $3,038. So basically, what that translates to is that the payment is now 39% higher than what it used to be. So that does make a difference. But again, is that a high rate? Well, I mean, 6%, it is a higher rate than 3%. I mean, it's almost twice the rate. But again, the rates, I think anything under 5% is very low. Anything above 5% is kind of standard. So the rates are not out of control. But the one thing that we need to keep in mind is this, and this is the way I look at it. Usually the traditional mortgage that a customer obtains, the mortgage payments represents traditionally around 35% of their income, just the mortgage alone. Okay. So if a customer makes $10,000 a month, a payment of 35% of their income is going to be $3,500 a month. You can get a mortgage for up to 50% of your income, but traditionally a customer average is going to be about 35% a month of their income. So now what's happening, if you get a mortgage for the same amount, the payment, including tax and insurance, back when the rate was at 3.25%, was going to be about $3,000 a month. But now, and that was assuming that the tax and insurance were, say, $1,000 a month. For a $625,000 property, you're talking about $1,000 a month on escrows. So now that translates to a new payment with a new rate of $4,038 a month. So basically now the debt to income ratio of the same customer, assuming that their income hasn't changed, is now 40%. So it has gone up. Is that going to keep them from buying a property? Well, it also has another flip on the other side of the coin.
Yeah.
Are the properties going to go down in price?
Right. And
so if they go down in price, then they may go back to 33%. It's all at the end of the day, my opinion, I think, is supply and demand. The characteristics and the underwriting guidelines to get a mortgage have not changed. They are the same. And again, like I said, debt to income ratio is up to 50%, sometimes a little bit even higher. But it's really how comfortable does the customer feel making that payment every month.
Yeah.
So that's the trend that I've been watching right now, that people are like not really stopping to get a mortgage because of the rates. They're just like, well, I wish they were lower. But the other thing too that is taking place is that the people that were paying 3% or that are currently paying 3% on their mortgage, they're going to sell that house and now they're going to pay 6%.
Right. So they're less likely to do that.
Well, I mean, they do have equity on that house if they bought it 2 years ago.
Right.
But then they don't have.
Right.
So that's just going to be additional money they're going to pull out of their house when they sell it and use it as a down payment. So it can all translate as long as the values of the houses stay consistently about the same of what they are or what they should be, which again is all controlled by supply and demand, then it shouldn't really have an impact. I still think that the rates are not very high, and I think that eventually is going to happen what happened last time. They're going to come back down. The rates do influence the marketability of a property. When money is, $500,000 is going to cost you $2,000 a month versus $3,000 a month. Yeah. People are like,
it's a big difference.
It's a big difference on the payment. Sure. So, but is that keeping people from buying? It is not.
It is not.
It is not. So,
but it's changing how much they can actually afford.
Well, obviously, for the same reasons.
The affordability.
It's the affordability. But I mean, insurance is going up. Electricity is going up. Everything is going up. So the mortgage rates are now going up. So, I mean, at the end of the day, we're just going to have to understand that things are going to cost you more money today than what they used to cost you before.
Yeah.
Are they going to come back down? Most likely they will. People say that they don't. I've seen rates come down. I've seen prices come down. I've seen things going up and I've seen things going down. But again, at the end of the day, people want to move to Florida. They want to be in the areas where we are offering financing and where you're selling real estate. So I do not foresee now. If we go to 10%, then that's a market that's a rate that I have never don't recall seeing.
Yeah.
I've been doing this since 97. Some people say, well, I remember the rates were at 10%, 12%.
Right.
I have not seen it. But again, under 7%, under 6%, it's still not as cheap. But when people have a lot of money to bring into the table because they have equity on the house that they're selling, it doesn't really make that much of a difference. So I am very optimistic of the market to keep moving the way it's moving. It's, again, as I told you earlier today, it's supply and demand.
Have you seen mortgage applications go down, the number of those?
Actually, to be honest with you, I mean, I just took 2 applications from a customer yesterday that is doing a refi. He's losing his rate that he currently has, but he wants to buy a property overseas. And so the rate that they were charging him overseas was at 12%. So I'm doing that. And people that are purchasing the rates, I mean, they ask what the rates are, of course, like anybody else. But at the end of the day, they're like, we got to buy this property. So if they really want to buy the property, the rate and the term of the mortgage is not really, I mean, the cash buyers are always going to be there. But even the cash buyers are calling about mortgages. Some of these cash buyers rather have their money on real estate than to have it on the stock market. The stock market has not been trending well lately. So these rates have not kept people from getting it. We're in a slow season right now. The season is going to start in a couple of weeks, I think. I think that we may want to talk in December to see how things are going. At the end of the day, also is the attitude and the way people feel. When people are happy, and when right now we see a lot of bad news, and now this is also not making people very happy. But keep in mind that the prices of real estate have been extremely hot. I mean, properties were being sold in a day, in 2 days. Now they're taking longer. And again, it's supply and demand. So I want to wait and see what happens towards the end of November, the beginning of December, and January. And that's going to be a more solid indicator of what I see, whether it's going to be the rates or not. I mean, people are getting, I wish they were lower. But guess what? They were too low.
Yes, they were too low.
I had a mortgage at 6% before. I had a mortgage. I have a mortgage right now at 2.5%,
nice.
Which I never want to get rid of. But,
of course.
It's like literally very inexpensive money. But at the end of the day, you got to keep in mind. I mean, you're going to pay $2,000 a month, or you were going to pay $2,000 a month on a $500,000 loan. You can't even rent an apartment right now for that kind of money. So it went up by another $1,000. Now that's for one person making that kind of money. When you have 2 sources of income, it is affordable. It is affordable.
Right.
So
depending on the situation, of course.
Correct.
Yeah.
Correct.
Absolutely.
So that's basically what I think is going to be supply and demand. The people that are going to lose their rate that they had before with the new property they're going to buy. The problem begins when they lose their equity. Now, a lot of people have artificial equity that they didn't dream of having just because they happen to have a house there.
Yeah.
And that they bought, for 50% less than what it's going
Sure.
for 5 years ago. So, I mean, that's equity though. That's money that they don't have before that they can use for a down payment for some other property,
Yeah.
or they're going to move somewhere else. But that's the trend that I'm seeing right now with the rates.
Cool. Awesome. Jose, this has been great. You have provided so much insight. We will circle back in December. I think that's a great idea to kind of track where rates are, also what you think the impact is of those rates going up, if they are to go up, right? And of course, if you all have questions and want to reach out to Jose directly, please do so. We have his contact information below. And if we can ever be of help, just give us a call.